Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, September 16th, 5:20 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the big show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what's important to know for next week, and update. Well, we're not going to update, we're going to review the world famous 21 over 21 leaders list. Going to kick some out of the leaders list and move them down to the under the 21 over the 50 list, and some are going to get booted because they broke the 21 and the 50, and then we'll start reconstructing the leaders list. I did talk about a baker's dozen of stocks that have been holding up pretty well in last night's video. We're going to take a look at some of those today. One of them had a great day yesterday and a terrible day today. Actually, two of them had terrible days today, and ironically, they are on the thinner side of what we consider acceptable, and that's very typical. I hate illiquid stocks. They're very easy to get shaken out of. All it takes is somebody that has a decent sized position to decide that it's time to punt, and you can get some very quick, very nasty down moves in those types of stocks. Not to say that all leaders, even if they are liquid, aren't completely immune to that, but we prefer to fish in the bigger ponds and then taking more of a gamble, so to speak, with some thinner stocks. So let's get right into it. Market state, we're in a correction. That's not news to anybody that's been following us. We went to correction on Tuesday with a massively negative, nasty reaction to the CPI report that came out pre-market. And you can see by our arrows over here across all three time frames, all five of the major indexes are in bearish/downtrend mode. That's relative to their short-term 21-day exponential moving average, their medium-term 50-day moving average, and their long-term 200-day moving average. Leaders still stuck on neutral. We've got some stubborn leaders that refuse to acknowledge that we're in a bear market, and that's a great thing. Corrections are one of the purposes that they serve. For our purposes, the biggest purpose that they serve is to separate the next rally's leaders from the stocks that need to be left behind. And usually during these corrections is when these stocks are building bases, and we're seeing a lot of that. Not really making progress, but they're going sideways. If you find one that's really making progress, that's a stellar standout that should definitely be identified. But we're going to go through a few of these tonight. Make sure you have them on your list as we do have them in ours, but also make sure at the same time you're putting risk in its proper perspective relative to where we are on the indexes. So we already determined we're in a correction, certainly since Tuesday. What happened today? Not a good day. 3,900 support broken. This has been a big support area. You'll see it when we take a look at the charts. Some leaders okay, obviously, as I've mentioned, but on the day, all red till you get to that beautiful last line that I'm happy to see. G6, this is our 6 ETF growth composite, down 2.3% on the day. That really was the worst of what we're looking at today from an index perspective. S&P gap down over 1%. Everything gapped down for the most part more than where it closed, with the exception of mid and small. They closed just a little bit worse, but the big caps came back a little bit. S&P down 0.7%. NASDAQ 100 gap down 1.3, closed down 0.6. Dow Jones Industrial Average gap down 1.1, closed down 0.5. Mid caps and small caps gap down about 1.2%. Mid caps closed down 1.4. Russell small caps down 1.5. Global diversified 60/40 stock bond down 0.51%. In-house, our flagship GROTECTION portfolio, another positive day, bucking the trend as we have identified that all three trends are lower. We want to either be in cash or taking advantage of lower prices. We owned SARK today. That's the inverse Cathie Wood ETF. and we finished the day up 0.19%. We'll get to the tail of the tape, and we'll get to the 2121 list review once I get to what has been pretty popular. We changed our format up a little while ago, and instead of just looking at the pictures of who works at Revere and telling you, we're showing you how we do it across the short term, the medium term, and long term time frames, as well as leadership stocks. This is and it's all visible here on a chart of the S&P 500. So you got your short term green line, 21-day exponential moving average, medium term red line, 50-day moving average, black line, 200-day moving average. That's our long term line. Like back in August or in October and November, when we were trending higher above all three of these, we are as happy to be as long as we reasonably can be, as long as we're comfortable. And when I say long, that means exposure to the market. And then if things start to slow down or roll over, go sideways, we're going to back off a little bit because our stops are going to take us out of the market. Not our opinion. It's the market telling us, hey, it's time to slow down a little bit. We might break below the moving averages, then bounce back higher. Sometimes you'll even get higher and try a breakout, and that breakout will fail. We're not going to call the top. We're not going to say this should have failed, but when it does fail, we'll react accordingly. And the top did come in on January 5th of this year. We bounced around a little bit, but then the slopes of the lines of the medium and short-term moving averages rolled over, and we went down hard in mid-January, including breaking below this black line, the 200-day moving average. And as you know, this is when risk is at its highest and we start to get extremely defensive. We had a couple bounces above the 200 after that, but started making lower lows, briefly made a one-day higher high, and then rolled back over again. The big day to the downside was April 21st when we tried to get back above, failed miserably, closed at the lows, broke short-term support, and that led to basically a free fall to the downside over the next couple of weeks, where the market gave up 700 points off of 4,500 points. Big pullback there. And of course, we're always going to bounce. We look at reasonable entries. We can get too extended to the downside. We can take an entry there, or if we get back above the green line, that's the first sign to maybe start dipping a couple toes in the water. We went sideways here for a while before breaking down again. Tried to get back in again, that failed. Tried to get back in again, that failed. Tried to get back in again, and that led to a double-digit run off of the lows, which we participated in until we ran into the declining 200-day moving average. That was where things started to come apart again. Started to roll over, our stops started to get hit, and then a big negative day here on 8/26 when Jay Powell said, hey, I don't think you're paying attention to me, market. We are going to keep raising rates until inflation comes down to 2%, and we're not going to stop raising rates until it happens. And we're not going to start cutting rates until we're convinced that inflation is under control. The market took a big flush, had one last gasp off of the low as this 3,900 level held. And then we had another big gap down on Tuesday with CPI. Terrible day in the market. This is when we went back to correction, hung around near the lows for a day or two, and then broke over the last 2 days. Here's that 3,900 area that I was talking about. It was a big battleground back in May, in June, in July, and again in late August and September, and we broke below it today. Now we see if we get back up to that. Does it act as resistance? That would be an ideal time to get either an additional short on or look for a move back up through it, which would be bullish. But for now, this 3,900 area, we're assuming that that's going to be resistance. If we get back up to it, if we break below today's lows, then we got to look to the bottom, and that's around the 3,800 to 3,815 area. We'll talk about that when we bring up the tail of the tape. Anyway, that's how we read the market here at Revere. We think it's a common sense approach. What other area of your life, when things start going south, do you not take corrective action? Why should your finances be any different? You worked hard for your nest egg. You don't have to give it back to the market. All you got to do is follow the biggest rule, which is get the heck out of the way when you're under the 200-day moving average so that you can avoid these big bear market drawdowns. We don't know if We know it was a bear market this year. We dropped 24.5%. We don't know if it's finished. We don't know if it's going to turn into a 35 or a 40 or a 50% drawdown, but we're prepared. We've got a plan regardless of what happens. And if you're interested in this approach, give us a shout. Reach out to me. Email me, don@revereasset.com. You can also email dan@revereasset.com, or you can call 855-REAL-WEALTH. That's 855-732-5932. Danny will answer that, and he'll point you in the right direction and answer all your questions. So there's your S&P 500. As I said, not a good day. We broke below 3,900. Do still have some leaders holding up. We'll look at those momentarily. Let's go through the rest of the indexes quickly. NASDAQ 100 broke below this 290 level. Bounced at a fib area, but ended up closing under 290. So we'll see if 290 ends up being resistance if we try to get back above it today. Now that it's broken, let's look at the Dow Jones Industrial Average. We had been talking about how this 31,000 area was key. A close below it yesterday, further close below it today. Although you see how we're finishing at the top of the range, so maybe the sellers are exhausted after this down move with this top of the range close. At least it's let's call it a green shoot for now, but that's all it is. We need a lot more good news to come out before we start getting back involved with the market. Mid caps, big gap down, broke recent lows, really more of the same. And IWM, small caps, broke recent lows, more of the same. These at least did close back inside their recent range of lows from the beginning of September, but it's unanimous. We've got all of the moving averages, all of the major indexes below their moving averages, and we've had a cross through two of the 21 going back below the 50. We went back, the 21 crossed back upside to the 50 in late July as part of this nice run off the lows, but now it's rolled over and we've closed back down below the 50-day moving average, and the 50-day is now flattening out, getting ready to roll over if we continue to hang out below it. Let's see how many exactly crosses we got. We also got the NASDAQ 100 has crossed below. The Dow Jones Industrial Average has crossed below. On the mid caps, we're just basically they closed right together there, so not quite across, but it will cross on Monday. And small caps basically sitting on top of one another too. So those are the indexes. We've made it pretty clear why we're net short. We own no positions except for an inverse of ARKK. This is the Cathie Woods ETF that has just really, Michael talked about it in detail on the podcast. Make sure you tune into his segment. He did a great job talking about getting the heck out of the way. He's, we really didn't have to train Michael when we brought him on board. He knew the system front to back, and it's just a matter of implementing the system. And great run up for Art K. Cathie's a hero. Well, she's a goat now because every gain, basically every dollar that was made during the post-COVID run has been given back. That's no way to manage a portfolio. I was going to say people's money, but she doesn't manage people's money. You can own this if you want to own it at your own risk. We've decided that yesterday when it failed, trying to get above the 50-day moving average, that we would go short the equivalent of this, which is SARK. We took half of our profits on this today, and the rest will be moved up to break even. So if this breaks below today's lows, that'll be a move back below the 21-day moving average on SARK. If it keeps trending higher, we'll stick with this small piece that we have until we get stopped out. But that's the only position that we have in-house, other than some things that recent clients have moved back in that we've hedged, or clients that have had big taxable gains that we have hedged. So let's take a look at the tail of the tape here. No surprise, correction, and technical headwinds in addition to the macro headwinds. VIX spiked as high as 28.45 today, closed right above 26, just barely higher. So it did the VIX did weaken, but still closed above this 26, above all the moving averages. Put call spiked to a high. This was some panic at the open today. High of 1.52, closed at 1.21. Fear and greed down to 36, which is in the fear range. We're operating under this bear case since the CPI report reiterated the 826 Powell speech, that they're fighting inflation, they're serious, and you should expect some pain. A little bit of news after the close yesterday. FedEx had a pre-earnings announcement. They were so bad they didn't want to wait. Big miss, cut their expected earnings per share in half, pulled their guidance for the rest of the year, and said, folks, we're thinking that we're seeing a global recession right here. And this trickled through to quite a few other parts of the economy, because if you're not shipping things, that means that you don't need boxes to ship them. That means that people that are selling shipped goods aren't producing as much, so they're not being bought. To me, this is the first sign that this is absolutely hitting Main Street. The Fed trying to engineer a soft landing. This is telling us that that ain't happening. So yesterday's day was down one. Today was down day 2. SPY went ex-div today. Why do I point this out? Because a lot of people look at the SPY to gauge the S&P 500, and they're going to diverge now because it paid out a $1.60 dividend. And by the way, if you want to invest in the S&P 500, don't buy the SPY. We hate the SPY. The reason we hate it is because they declare the dividend now, but they're not going to pay it out for over a month, which is absolutely ridiculous. Holding on to your money like that, it shows at quarter-end statements, if you have the SPY, that you're $1.60 per share less than you truly have coming to you. That doesn't make any sense to me. So IVV, SPOO, SPYG, SPLG, you can own all those. Don't own SPY. But it did declare, it is the most widely tracked, and it did declare ex-div today, and it does track the S&P 500 the most relative to the other ones as far as what its price is, but not a good instrument. So expectations obviously coming into today negative, with the CPI killing the rally. We had the gap down, the put call spike, and a chop day. Yesterday's support moved them to support resistance. We gapped below those. The next levels down did hold. So those are your new resistance, or your new support levels for now. Cut base most of the day. Let's take a look at what we did on the S&P 500 on a 5-minute chart. You can see the gap down, quick bounce off of this 38.37. Basically, this 38.37 to 38.74 area contained the rest of the range for the rest of the day. We formed this big cup and put in a handle, but we're at the top of the handle. No breakout here. As I mentioned, we're looking at this 3,900 area to be resistance should we get back up to it. What's next? What was good? What was bad on the day? Staples outperformed, semiconductors outperformed, gold and gold stocks. ITB builders got a bounce. Relative strength to the plus side were utilities, healthcare, real estate. The dollar started out strong, which coincided with the gap down, but it faded to flat by the end of the day. Let's take a look at the UUP very quickly. Big move up, along with basically this did the exact opposite of what we saw with the indexes. Big gap up on Tuesday after CPI, going sideways since then. Hasn't made relative highs yet, even though the indexes have made relative lows. So something to keep in mind there, but dollar continuing to show strength, not good for stocks. On the downside today, oil's weak all day. TLT down, which means interest rates were up. That's for the 30-year. Biotech very weak today. Transport's very weak because of that FedEx announcement. Let's take a look at Biotech very quickly. The preferred ETF for us is XBI. This led a little run back in late July, early August, but lately it's been running into the downtrending 200-day moving average and unable to get above it, and now broke back below the 21 and the 50 today. So Biotech goes from a leading sector to just an also ran sector. These focus stocks will be reviewed when we go through the 21 over 21, but I do want to point out Apple and how it's not acting well at all. We bought Apple on Monday with this massive volume. It was just strong all day, got back above the 50, the 200, and the 21. We drank the Kool-Aid, got stopped out the next day when it broke below the 200. Very small loss, and it's showed no strength. And if Apple can't go higher, the market's not going higher. Also gapped down today, broke recent. This is as far as recent support goes, it's acting even worse than the Nasdaq 100 and the S&P 500, and that's very clearly not a good sign for Apple. But note that big move up is keeping, although price is below where it was last week, relative strength wise, because of that big gap up. Was so exaggerated. We haven't made a new low with the relative strength, so that's a positive divergence at a minimum. So back here, what do we do? I said we trimmed half of our SARC, so our adjusted beta is a negative 0.04, and the bottom line for the market right now, indexes under all moving averages, some leaders holding up. Let's slide this up so you can see the next support level. Here we closed at 38.73, this 3800 to 3815 big level. Keep an eye on that next week. It's the 20% year-to-date level. That's what 39.13 is. 38.15 or 38.13. 38.15 is the high of the year. 20% off of that. So, and then down that 38.2% fib. Also in this area right here. Actually, that's what 38.15 is. 3800 to 38.13 is the 20% year-to-date drawdown level, and then below that is our most recent lows, 37.40 to 37.45. So that's your market. Let's take a look at the 21 over 21, and first the two stocks that very clearly got knocked off. I crossed these off yesterday and today. Not MRK, MCK. Broke below the 21, broke below the 50. This was a medical wholesaler. Taken off the leaders list and the 2121, and also PWR. This was a heavy construction stock, broke the 21, broke the 50. So let's take a look at the survivors. They're sorted here by today's price change. So strongest on the day going to be at the top. No surprise to see First Solar there. This thing has not even touched the 21-day moving average since its gap up on 728. Strongest stock in the market, 99 relative strength at a new high, price not at a new high. That tells you how strong it is. That's the sign of a leader. Look at all these big blue up bars, up volume day. Anytime it's pulled back, it's been average or below average volume. This just looks great. And my expectation for this, if the market is going to correct, is that First Solar will build a base here, either a tight flat base or 3 weeks tight, something, but very clearly money has flowed into the solar sector, and FSLR is the leader there. Wolf, nice last week and a half after bouncing off the 21-day exponential moving average, leading relative strength at a new high. BJ's, since it's even above, this kind of like is a cup with a high handle, acting great, relative strength at a new high above the 21. Enphase, solar stock number 2, hasn't really done much since the second day of this big gap up here, but very clearly holding the 21, and it is in the leading sector. As you can see, group relative strength here, A+. It's got a 99 composite. It's got the fundamentals. It's got the technicals. It's the total package. The only thing it doesn't have is the M in market to support it. Sarepta, undercut reclaimed. It's a biotech, undercut reclaimed the 21. Biotech's weakening. This one's still holding up. ON Semi closed right on the 21. We sold this Tuesday with the gap down. Gone sideways since then. If you've gone sideways since then, you're actually showing relative strength, as you can see over the last 3 days. So still one of the leading semiconductors. Don't like that its earnings are supposed to slow down for next year. Shockwave, undercut, closed right on the 21, still hanging in there. LTHM, Livent, continues to bounce at the 21. Technical analysis doesn't work. We don't care about your moving averages. You're going to tell me that the 21-day exponential moving average just happened to coincide with the lows of all these days? Sure, Jan, as Marsha Brady would say. Tesla. This is the big leader that we need to grab the reins and take the market higher. It's set up. It's biding its time. Accumulation's fine. Really, because it closed at the top of the range today, is not a distribution day. Undercut, one close below the 200, back above it. We sold this at 290. It's at 303. We will not hesitate to get back in this. Look at the relative strength over the last 2 weeks. It's not being sold hand over fist is the bottom line for that. Alta has been sold the last 4 days. So this is basically a failed breakout and a close under the 21-day exponential moving average. Chipotle pulling back finally. Really, it's not quite a failed breakout yet because it hasn't hit the sell point minus 7 to 8%, holding above the 21. This is one that I want to get into if the market rights itself. CEG, this is an alternative energy stock pulling back, but with some volume and some heavy selling. Heavy selling, can't really say it today. Today was quad witching. That means options expiration across the board. And you see volume is usually exaggerated on those days, but this thing is acting just the way you would want a leader to act. Just, again, doesn't have the market participating. Exxon goes on the over the 50, under the 21 list. CF also goes on the under 50 over the 21 list as it gave way finally. It had been weakening for a while on a relative strength basis. We don't want to go back to the top. We want to go to LNG. Not a good day today for LNG, down 2.8%, but holding the 21-day exponential moving average. Palo Alto giving way, sitting right on the 50-day moving average coming off this list. CCJ, not a good day today for CCJ. This was one of the leaders, cup and handle forming, gave it up today on above average volume, still above the 50-day moving average. So, and actually just closed a hair below the 21. I might keep this on here for now. PDD, Pinduoduo, tight for 3 weeks, below that range now, sitting on the 21. And finally, AXSM, Biotech, closed right on the 21 as Biotech's weakening. This one is going sideways, which is hidden strength despite the price pullback. And that is going to wrap it. So, well, I want to talk about those two that I mentioned yesterday that are thinner, that got taken to the woodshed today. ENVX is the first one. Nice big up day yesterday, tried to break out above average volume, 2 days of above average volume on today's pullback, giving back 11%. Okay, it's a $21 stock. It trades $4.4 million. So it is $80 million, actually almost $100 million in daily dollar volume. So not as thin as I initially indicated, but lower price stocks in the 20s are more volatile. Got to see how this shakes out. And the other one is AEHR, the one I've been talking about. That's test equipment for silicon carbide. Down 8% today. Still a great looking chart, but this is a true thinster. Trades 1.3 million today. It's only a $15 stock. So that's going to wrap it. As always, love to hear some feedback from you. You can email me, don@revereasset.com, or you can call us on 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the market, it's how much you keep. You do not have to be a slave to the market, giving back your gains because the market is not in your favor. And if you think it's too late to sell, you're absolutely wrong. I showed the statistics for bear markets. We're under the 200-day moving average. We don't know how low we're going to go. For all I know, today is the low, but we're prepared for any outcome. And if you'd like this approach to be your approach, give us a shout. So wrapping up the week ending September 16th, this is Don Vandenbord telling it like it is. Thanks for listening and have a great weekend.